Hi, everyone. Thank you for coming for the second investment presentation for Oman REIT. Our first one was hosted last year in October, and the plan is to do that at least once a year, to increase communication with investors, get to give a forum for everyone to ask any questions, in addition, obviously, to all the information that's being shared on our website, annual report, fact sheet, etc. So I'm just going to give you a little bit of a brief overview for those of you who are not familiar with Oman REIT, on the fund, on FIM Partners, who are the REIT managers. And then we'll talk a little bit about, in more details, about the portfolio, about what we've been doing over the past 24, 30 months in terms of our business plan implementation, and talk about the latest acquisitions that we've done in the year of 2024 and the way forward. So Oman REIT was listed originally on the MSX in February of 2021. It's the first multi-asset REIT in Oman, currently holds 19 assets across office, residential, retail, and logistics asset classes, has a total GAV, a gross asset value, of 72 million riyals. FIM Partners has taken over the management of the REIT back in July of 2022. I'll give you a very brief background of who we are for those of you who are not familiar with us. FIM Partners is a regional asset manager that was founded back in 2008. We manage circa $4 billion of assets on behalf of predominantly 95% of our investors are institutional investors. Our main offices are in Dubai. We also obviously have offices in Oman. We have offices in Riyadh, and we have offices in London. We manage 4 asset classes, mainly public equities, fixed income, real estate, and private equity. On the real estate side, we've been quite active in Oman. In fact, we've been investing in Oman for the past 6 years. We manage, including the REIT, we manage circa 120 million riyals of assets, real estate assets in Oman. Our main strategies are in 2 buckets. We do income generating assets, but we also do development, and the focus is purely regional. So we're experts in the region, and we've been familiar with Oman for a good amount of time. So in terms of Oman REIT's portfolio, so as it stands today, Oman REIT has 68 million riyals worth of assets, with an occupancy weighted average of 91% across its assets, a portfolio WALT of 4 years. So WALT stands for weighted average unexpired lease term. So across its assets, on average, leases have an unexpired term of 4 years. And it comprises of 19 different properties, as I was saying, that span across office, retail, industrial and logistics, and residential. Over the last 24 months, just to talk very high level about the portfolio performance, our revenue has grown by 48%. Our occupancy has increased from 75% to 91%, so that's an increase of 21% on occupancy. NOI has grown by 70%, and the dividend yield has increased by 40%. So we'll talk about how we've been able to achieve that over the course of the last 24 months. So back in 2022, when we started managing the REIT, we had put a business plan in place, and this has been, a very interesting journey to implement that business plan. The focus is mainly three to four elements that we really have been working on to continuously improve the performance of the REIT. Number one, when you're looking at the NOI of the REIT, obviously, if you're looking at it very simplistically, you're looking at top line and you're looking at costs, right? On the revenue side, As you've seen, the revenue has been growing quite consistently. This is mainly due to acquiring obviously new assets, but also focusing on enhancing rental rates and focusing on enhancing occupancy. So on the occupancy increase, so the way we've done that is that number one, we have been working very consistently with property managers, leasing agents, marketing companies. We've implemented a rate card for each one of our 19 assets to make sure, we're benchmarking rent to market. We are setting targets that are achievable versus, saying that this office building, I want to lease it, for example, at 10 riyals a square meter, and it remains empty. If the market is at 6 or 7 or 5, I recalibrate, and then I drive my marketing efforts in the direction of, leasing up the space. That's number one. Number two, we've been working on value add initiatives on a few select assets where we thought the locations make sense, the asset quality is potentially lacking a few elements that could be improved. So far we've done that on 3 assets. Last year we have spoken about Beit Muzna and Wafi villas. These assets had an occupancy at the time of 65-66%. Now both assets sit at, one at 88%, one at 97%. What we've done is just spending a little bit of capex, and when I say a little bit, on both assets combined, I think we were in 30 to 35,000 riyals, adding common areas, adding free Wi-Fi, just refreshing the space, the common areas. On one of the assets, there were an empty plaza that we converted to a landscape area with a playground for kids, etc. And just by doing that, we were able to, within 3 to 6 months, increase the occupancy for one asset by to 88% and another one to 97%. And by the way, that occupancy has been stable throughout the last 12 to 18 months, which tells you this is, this has really worked with the market. We've done something similar on our COM4 property. So this is the largest asset in our books at the moment. It's an office building located in COM, in Knowledge Oasis. 2 years ago, it was an asset that sits at 56% occupancy. Today, we're at 77% occupancy. A year ago, we started spending, again, very similar amounts of capex to create common areas in the building that can be used by the rest of the building. So meeting rooms, facilities, and entertainment space for the tenants that can be booked, where you can host events, where you can host conferences, etc. has been quite successful. We also were looking at parking, so we've been working with COM. They have been working very collaboratively with us to enhance the parking ratio for the building. So we've added another 150 odd parking spaces for the building. And with all of these initiatives, we were able to increase the occupancy quite dramatically to 77%. And we're still working, obviously, on a number of different leads to hopefully increase the occupancy further. And number 3, there's market as well. So market has moved a little bit in our favor. Obviously, as compared to 2 or 2.5 years ago, we've seen markets stabilize further. Marginal increases in rents are achievable now, and obviously increase in occupancy. And we started seeing, again, population growth to a certain level that's been helping occupancy move up. On the other side, on cost optimization, this is something that we continuously work on as well. So we've been working on continuously renegotiating existing contracts with FM providers, property managers, to continue to control costs. Maintenance as well is very streamlined, so we have a process to continuously control costs. We get 3 quotes on every single maintenance work that we do above a certain level. We have deployed a mobile maintenance team to do all lower ticket sizes for maintenance. So anything that's, let's say, below 100, 150 riyals, what you end up doing, and this accounts for a big chunk of your maintenance costs, what ends up happening is you go to smaller contractors that end up charging you a higher margin. So the way we've done it to control that cost, and it's been working quite well. I believe we were able to reduce costs of 20% on that particular line item by deploying a dedicated mobile team that takes on these jobs, and then what we tender or what we get bids on is the items at cost, and then you control any margin that any maintenance team charges you. So that was another initiative that we've taken over the last 12 months. And then there's utility management. So we continuously look at alternatives to control utility costs. Utility as a percentage of revenue, as relative to revenue, utility costs has dropped by 17% over the course of the last 12 months as well. So that's on the NOI. And then obviously what we've done is that we have gotten a facility back in July of 2023, a financing facility from MUZN, which is the Islamic arm of National Bank of Oman. It's a facility of 30 million riyals. We've been deploying that into yield accretive assets. So far, we have deployed circa 60% of that facility in 3 different assets. Last year, when we had done our first presentation, we had acquired the Nesto Wadi Kabir, which is a retail asset tenanted to Nesto with a 15-year lease. We bought it at a 9% cap, which was a very good deal and very good addition to the portfolio. Since then, we've also acquired 2 logistics parks, and I'll get to why we're selecting specific asset types as well in a minute. But we've acquired 2 logistics parks located in Rusail. Both are 100% occupied. They were acquired at a net initial yield of 8.5%. So again, very good addition to the portfolio. They had a WALT of, call it, 4.5 years, which works well with the rest of the portfolio. Now, if we're looking at our portfolio and we compare it as to when we started managing Oman REIT. So back in 2022, office was 43% of the portfolio, residential was 25%, retail was 20%, and industrial was 12%. Now, obviously, if you look at Oman REIT and you look at the market at that time, we were substantially overweight on office, and we were substantially overweight on one particular asset in the portfolio, which was Com4, which at the time represented 32% of the portfolio. So, you know, your impact and your volatility on performance increases because you were overweight on one particular asset class and you're overweight on one particular asset. So what we've been working is working on rebalancing the portfolio. Today, office comprises of 29%, so it was reduced from 43% to 29%. Residential was 25%, it's now 17%. And what we've been doing so far is increasing our weightage on real estate and on industrial, on retail and on industrial. Retail, when we say retail, the focus is purely on community retail, so it's very defensive. You know, assets like the Nesto asset that we have acquired, hypermarket, defensive assets, good tenants, long leases, right? And the focus is going to remain in that direction. And number 2, industrial. At the time when we started managing Oman REIT, industrial was at 12%. We believe it was a substantial underweight, so we increased it to 27% with our 2 acquisitions as well. So taking a look at the way forward from a portfolio composition perspective, we have a transaction which we'll talk about in a little bit more detail in a minute, but we have a transaction that's comprises of a fifth asset class. So we believe it will be a very good diversifier to the rest of the portfolio. It's in an alternative asset class, and it will comprise, when completed, inshallah, it'll comprise of 16% of the portfolio. So our target for 2025 on the back of this transaction is to end up with less than 25% on each one of the existing asset classes. So we're looking at 24% for office, 23% for retail, 23% for logistics and industrial, 14% for residential. We wouldn't be looking to increase weightage on residential and probably not on office as well. And then there will be this fifth alternative asset class that should be forming part of that portfolio. And the strategy, as well as and when we continue to grow the portfolio of the REIT, is to get to a point where no single asset is above 20% of the portfolio. Again, taking into account that 2 years ago we had overweight on one particular asset that will form 32% of the portfolio. The plan is to get to less than 20% per asset. This also allows us to continue to diversify the portfolio, reduce weightage on any one particular asset. And again, every single asset that we're looking at the moment has long WALT. So from a weighted average unexpired lease term of the entire portfolio, we're looking at increasing the overall tenor by a few years. So our target is to move from 4 years at the moment to 7 years, 7 to 8 years, hopefully by next year. So we have one asset that's currently under exclusivity that we believe will fit very well in the portfolio. It's a long let asset with a very solid tenant, solid financially, solid as a brand name. It's, as I was mentioning, an alternative asset class. We'll be able, hopefully in the next month or two, to disclose more, but at this stage, that's what we're able to disclose. And in terms of the yield, entry yield, it will be very similar to what we have done so far with the last 3 acquisitions over the course of the last 18 months. So with that, our expectation is to achieve a dividend yield of 1.7% at par value over the course of the next 2 quarters, which translates to close to 7% per annum. Again, that's at the par value. So on share price, at the moment, it'll be obviously higher. So in summary, that's the update. Obviously, one last thought in terms of how we've been dealing with investor communication as well. So we've introduced a number of different elements that we continue to build on and that we're going to do very regularly. Obviously, we have a website for the REIT that we continuously update with general updates, as well as any updates on portfolio performance, on asset level performance, etc. We've introduced the annual report that we do annually that, again, gets more into the details of any initiatives that we're doing, similar to the update that we're giving you now, asset level performance, financials, etc. We've introduced a fact sheet that we will do on a half-yearly basis. So every 6 months, we will also, in the interim, like halfway through the year, we will give you an update in terms of the portfolio and asset performance, any acquisitions that we're doing, any material information. And finally, we have this forum that we plan to do every year, and potentially more if needed, if we believe there is more material information that we want to disclose, to give you an update, but also to welcome any questions from the market. So in summary, that's our update. Tamir, I don't know if anything you want to add, or Ismail, otherwise we're happy to take questions.
No, Bismillah. I think Faris has spoken at some length about the real estate portfolio and income distribution. So I want to speak a little bit about Oman REIT from a public markets perspective. From a public markets perspective, our aspiration is the first aspiration that we have for our investors is to protect the NAV value, which is the asset value of what's owned by the unit holders, number one. Second aspiration is to hit circa a 7% net dividend yield on the back of leverage which is below 40% on the portfolio level. And the third aspiration is, from a diversification perspective, balance asset classes and not have any asset or any class which is disproportionately large, which can impact the performance of the cash flow if an unforeseeable outcome takes place. The fourth is obviously efficiency, and I think Faris has talked about efficiency from a top line and a bottom line perspective, where rate card growth, occupancy growth, and increase in scale all used to drive the top line, and utility management, facility management, general overhead management, and contractual renegotiation to drive down the bottom line to increase that margin. And doing all of this, if we can extend the vault to circa 7.5 years, what that does is it produces an investable product that has a higher dividend yield than the average, for example, of the Saudi REIT index, where the dividend yields are in the lower sixes, and the dividend yield that I'm mentioning is at the NAV level. So today, let's say the price today is 0.75, and that will lead to a net dividend yield of just shy of 10% for 7-year vault income in a diversified stream, which is where we have really done a lot of work to make sure that the margins make a lot of sense. So the leverage at the fund level, we intend to keep at a very conservative level. And if there are any gains coming from a reduction in the interest rates, obviously that's another pass-through benefit to unit holders who own the unit. So we've been approached over time by various different investors who are looking at the acquisition at this level and evaluating the yield story. We have taken some initiatives to explore whether we can convert this into a Sharia compliant REIT, which opens up the door for a broader base of investors, including some of the various awqaf and endowment funds that have been created recently and over time. So that's in a nutshell from the sort of the investment perspective. I think Faris has been talking a lot about the real estate perspective. So that's the overall picture. Happy to take questions from anyone specifically on the strategy or any of the assets, or any queries or concerns that anybody may have on this. If you could, is that reduction or?
No, I was referring to rental reversions, I mean, for going forward 2025. What's your outlook?
You mean the view on rents?
Right.
In terms of the overall market, what we are finding is rents are starting to pick up. And if you look at the research that's put out, there is a little bit of a movement at the rate level. And that's an aggregate number. So if you have good assets, they're well positioned, you may actually do better than the average in certain cases. From our perspective, I think we are seeing across the board, if I had to average 2%, 3%, 4% rate card growth. In our story, of course, we've got another 12, 13 million of acquisitions that are going to happen as well. So there will be a top line growth as well, which is what is driving that the dividend number higher. So from 5.3, 5.4 today to 6.8, and all of these numbers that we quote are on the NAV. Obviously, on the current price, that's a much higher return. So we. Faris, any other thoughts on the revenue going forward?
No, I think, look, if we're talking about the REITs specifically, there are three, and we're looking at revenue, there are three elements that we continue to work on. Obviously, as Sami was saying, is new acquisitions. At the moment, we're at, we have another 13.7 million riyals from our existing facility with NBO to acquire new assets. And this is going to be, again, in the same yield accretive assets that will vary between, call it 8.25% to 9%, which will move, as Samir was saying, dividend yield from 5.6 on NAV today or at par, on par value to closer to a 7% figure. Drive on occupancy increase continues. So even though we're reached 91% weighted average, which is above market occupancy for sure across asset classes, but the way we've been doing that is what I was explaining a few minutes ago, but also targeting long let fully occupied assets, right, which helps us continuously enhance the weighted average occupancy of the portfolio. Now, if we're talking specifically about market trend, we do not see material increases in market trend overall, but for sure, over the last 12 to 24 months, we've seen market trends stabilize and maybe a little bit of an uptick. Yeah, a couple of percentage points, depending on the asset, depending on the location. We see that, but are we seeing rapid increase in rental rates? I do not see that happening over the course of 2025.
And the advantage.
Sorry, every time.
The advantage that we have with long leases is there are contractual escalations also built in. So depending on what percentage of that income is long let, every 3 years, every 5 years, there are step-ups on that. So there's that contractual escalation, and then there's the market rate escalation as well.
Thank you. One more question. While you mentioned about acquisitions next year, and specifically the alternative sector, which is quite exciting, we are looking forward to know. At the same time, are there any plans for divestment, to divest any existing property and then perhaps switch it to another idea?
So there are no plans that are, there's no decision that has been made on divestments as of yet. There are 3 assets that we are potentially looking to exit, which are the 3 RUI assets, which are residential and commercial. Combined, they form now less than 3% of the portfolio in terms of value. We think they historically may have misbranded the REIT a little bit, given that they're not in the right location and they're older assets and they're underperforming a little bit. But they don't really impact the performance of the REIT at all. But we would look at exiting these assets if we are able to hit book value, right? So what we've been working on is continuously enhance the performance of these assets. And if you look at these assets specifically, and you look, for example, at the occupancy 2022, 2023, 2024, you see a gradual increase in occupancy on these assets. For example, one asset could have been occupancy is 35%, now it's 58%, right? So we are gradually working on this. It's hard work because the assets are in the wrong location, and they're not, I wouldn't think from a strategic perspective it would make sense to spend CapEx money on it, on these assets to improve the quality. But yeah, if we are able to hit the valuations, the book value, which we believe from an intrinsic, from a fundamental perspective, this value is correct. It's just that the yield is a little low. Then we would look to offload those assets. Beyond this, I would say the portfolio assets is well balanced now. The assets are performing well, so there are no immediate plans for any further divestments.
Hello. Yeah. You have shown that the expenses have reduced. So I have two questions. One, the percentage what you showed, whether that is percentage on an income or it's a year-on-year improvement. And number two, do you think that the reduction in expenses what you have achieved will continue or it is stabilized?
Sure. So the first question, Girish, the answer to it, it's a year-on-year improvement, right? That's number one. Number two, you know, it becomes a bit more difficult to achieve the same rate of improvements looking forward, because it's a balance between controlling costs and maintaining quality as well, right? So you get to a territory where it can become counterproductive to continuously look at further reducing these costs. But we're still looking for areas of improvements. I think there will be a little further improvement on that front, but it would definitely not be at the same scale that we have done historically. What we have done historically is we've taken over from a previous manager. We've looked at things that we believe we can improve. We've streamlined processes. We've renegotiated contracts that we believe we could get better terms from service providers on. We've looked at utility consumption. Beyond that, it becomes a bit more granular and a bit more asset focused and asset specific, which we are doing on a continuous basis, but the magnitude of it would definitely be lower.
I have a question about the triple net leases, which will be part of your income. What's the percentage at the moment, and how do you look for it going forward?
So you said the percentage of? Triple net leases.
Yes, triple net leases.
I don't have that figure. I think we're close to 45 to 50%. I'll get you the exact figure, but I believe I don't know if you can calculate that, Ismail, but it's circa that. The new acquisition, which would be 16% of the portfolio, is also a triple net long let asset. So we would be looking for from shifting to the number that we're going to get you in a minute, which is roughly around the 45% mark, to closer to 60% for the way forward. But we'll give you that number in a minute. Portfolio value, let's say total assets, the triple net leases at portfolio value. We'll get you that number in a minute. I don't know, meanwhile, if anyone else has any further questions. How much? So we're at 40% actually at the moment, and we will get to call it 56, 57%. And the idea is exactly that, just to build on your question, is exactly what we're saying, shift the world from 2022 was two years, 2024 we're at 4 years, 2025 inshallah we're closer to 7-8 years, which will help you stabilize the overall portfolio and the NOI, which will become more predictable, and then will also help from a share price perspective. So that's the target.
And that's accretive for us on. We're getting a sonic boom. So the triple net lease obviously helps the margin, right? Because it's already calculated at net. So it's just registration cost that is expensed out. And as far as said, the length expands as well. Most of our acquisitions, would average, let's say, circa 8.5% at the asset level. Some are a little higher, but I think that's a good average. And as we rotate that income in towards more contractual, two things will happen: the margin will increase, the WALT will increase, and escalations will be contractual. So, you'll have better predictability on the NAV, and then you'll have a better predictability on the growth of that income as well.
Look, if no further questions, I think that's it from our side as well. Thank you everyone for coming in and attending, and for all the questions. We will keep everyone posted, hopefully over the course of the next 2 to 3 months as well on the new transaction. We're looking forward to continuing to improve the performance of the REIT and to continue to communicate with everyone. So thank you again for attending.
And there's obviously food.
Yeah, of course, there are some refreshments as well outside, so please help yourselves. And yeah, thank you very much.
Thank you all for